All right, welcome everybody to our live discussion. Today I'm here with Alfonso Peccatiello, author of the Macro Compass and former head of $20 billion fixed income investment portfolio. And today we're going to be discussing the global macroeconomic picture. Mr. Alfonso Peccatiello, welcome.
Hey, Kaya, it's a pleasure to be here.
Thank you. It's a great privilege to have you here. So having mentioned your role as a fixed income portfolio manager, I'd like to ask you this question. What is the general trading framework or strategy of a fixed income portfolio manager?
Yeah, so basically what you learn being on the other side and managing a large pool of money is that you need to be humble. That's rule number one that you learn. Because if you are not, and you take outsized risks compared to your risk appetite or your risk framework, Kaya, then the market will humble you if you're not humbled by yourself. So the strategy all lies about limiting risks and finding trades that have what I call a good upside compared to the downside. And you can do that in a couple of ways. I mean, you can find trades that by design will have a limited downside and a big upside. For instance, if you trade options and you buy options, Kaya, then you spend the premium and you know how much are you going to lose. That's the premium of the option. But if you're right, then the payoff of this option can be very large, right? So these are trades that by design can work. And the other way to make the trades work, as I write in my newsletter in this article, 5 rules not to suck at this game. The very first rule that I always say is you can design these limiting losses and letting profits run by using stop losses in a smart way. So you basically put a bunch of trades on. The ones that work, you make them work going forward. So you don't cut them. You don't take the profits too early, basically. And the ones that are not trading well, you kick them out.
All right. Appreciate this knowledge. So now I'd like to move on to the macroeconomics. So given how events have evolved over the past few weeks, what do you think, changed in terms of monetary policy in the US and in the Eurozone? I mean, in the US, we were talking like just a few weeks ago, we were just talking about a 50 basis point hike instead of 25 basis point hike. And now that probability has come down. And in terms of, and as you know, the Fed will do quantitative tightening. And given what we heard from Chairman Jerome Powell, we know that the Federal Reserve will conduct quantitative tightening primarily by not reinvesting the maturing U.S. Treasury securities. But given where the inflation rate may evolve over the coming periods, do you think outright sales of U.S. Treasury securities might be an option for the Fed?
All right.
How would you evaluate that?
Bunch of questions to unpack. Let's start from the big picture. It's what I like to do best, at first at least. So central banks are in a very tight spot. I wouldn't want to be in their shoes, to be honest, because the level of monetary policy accommodation compared to how quick growth was picking up in 2021 was probably excessive, which has led to the fact that fiscal deficits basically pushing economic growth very sharply have also led to economic activity picking up and inflationary pressures as well, while monetary policy was still kept very accommodative. That's the story of 2021. Yeah. So you then enter 2022 with inflation in the US at 7.5% and in Europe at 5-point-something%. So those are levels which are way, way above the 2% symmetric targets that these central banks have. So at this point, if you're a central bank, you understand that you are behind the curve, as we say in bond market, which means you have been way too accommodative compared to what your targets are, right? So you try to dial back some of this accommodation. The problem here, Kaya, is that the economic growth impulse has also slowed down. We are still growing, but the pace of this growth has started to decelerate from summer last year. So as we grow, but we tend to grow back to our trend levels, which in the US is around about 2% real GDP growth. We are slowing down and going back to the trend growth. The moment you change the pace of growth and you slow down, and at the same time you want to remove accommodation, it becomes a pretty difficult dance to balance out. And that's what central banks are trying to do. They're trying to balance out these two components. And, bond markets as well have been very clear in what they think. They think that both the Federal Reserve and the ECB will tighten. They will decisively try to remove accommodation. But by doing so, they will basically damage the already slowing down economic growth impulse, which means that if they tighten now as aggressively as they plan, future growth will be hampered. And that's reflected by the fact that yield curves are flattening. So front-end bond yields are going up at a relatively fast pace, reflecting this tighter monetary policy in the next 1 or 2 or 5 years. But then third-year bond yields are not managing to move at all. Actually, they've even dropped from summer last year, reflecting the fact that structural headwinds to long-term growth will be compounded by this tighter monetary policy stance now.
Yeah. So as the strategist Mr. Zoltan Pozar says, he wrote it in one of his articles, the short-term money markets from the maturity of overnight to, let's say, 1 year, they are mostly governed by central bank actions and what they say they will do in the future. And when you look at 2 to 5 year bond yields, they're also they're also about policy expectations. They track central bank actions. But when you look at the 10-year and 30-year bond yields, they're more governed by the macroeconomic fundamentals like growth, aging of the population, labor force participation rate. So they are what we can refer to as the gauge of the economy. So my question to you would be, where do you see long-term bond yields headed in the Eurozone and in the US?
Yeah. So I will tie the answer to this question to the other question I didn't answer before about quantitative tightening and active sales from the Fed, from their balance sheet, if that is an option or not.
Yeah.
So 30-year bond yields in Europe and in America and actually in all developed market economies have been trending down for the last 40 years basically in a relentless way, effectively. So if you look at the chart of a 30-year bond yield, America, for example, US 30-year bond yields over the last 40 years, you will see that there is a very clear downward trend. It's really clear. And around this trend, there are some cycles, right? So it's basically imagine one trend line channel all the way down with some cyclical upswings and downswings around that channel. But the channel is very clear. It's been down for 40 years. And why is that the case? It's because what drives, as you correctly say, long-term bond yields is much less monetary policy action on a structural basis. It's much less that, and it's much more the structural forces behind economic growth and inflationary pressures. And those are the labor force growth and the productivity of this labor force and the productivity of capital that we throw through our economy effectively. So total factor productivity and labor force growth. Again, we have to think in growth rates terms. And so basically 40 years ago, we saw the peak of the labor force growth in the US and in Europe. So back then it was growing at about 2.5% a year. So year after year, our labor force was becoming bigger and bigger and bigger. And that's the basically the outcome of the big demographic boom we had in the 50s after Second World War, which led 20 to 30 years later to all these kids entering the labor force effectively, right? And so this boost enlarged the pool of people who were actively contributing to the economy back then. Also, aging was not so bad back then, which meant literally you didn't have people retiring that often, but you have a lot of people entering the labor force. So that expanded. Also, productivity back then was around about 2% a year, more or less, and today is estimated in the US to be 1.5%. So that really didn't change much. But what changed over the last 40 years is that labor force growth has become to shrunk pretty aggressively. And that's because the demographic boom after the 50s started to slow down, and world population growth year after year has been on average 0.5%. That's it. Over thousands of years, if you draw a graph population growth, it's only 0.5% a year. There has been this particular boom post Second World War due to the fact that economic conditions were improving rapidly and that people were much more, let's say, keen on future prospects of economic growth after two world wars world worse, and the reconstruction was there. So we had this temporary few decades worth of demographics boom, which led to this very fast labor supply growth, which led interest rates to be temporarily pretty high. But then we went back into our long-term channel, which is also compounded by the fact that our monetary system relies on credit creation. So what we do is, once this structural growth tends to slow down, so potential real GDP in America in the 80s was 4.5%, according to my estimates. Today, it's about 1.5%.
Yeah.
Now, no politicians wants to grow only by 1.5% year after year. I mean, that's okay, but it's not really palatable. It's not really socially acceptable. So what we do is we lever up. It's very simple. If you don't have money to buy a house, you can go to a bank and you can get a mortgage. And all of a sudden, you have the money to buy a house, right? That's credit. It's the creation of new money, effectively. But this credit needs to be serviced. So to make more and more and more leveraged private sector able to service this debt, you tend to lower equilibrium real interest rates. So the interest rates necessary for the system not to blow up under these excessive levels of leverage are obviously lower and lower and lower. So the combination of excessive leverage that we continue to build year after year, decade after decade, and lower structural growth lead to this pretty strong and well-rooted long-term trend in 30-year bond yields everywhere in the world.
That's why credit is initially inflationary, and then it becomes deflationary unless properly dealt. And so I think we've mentioned the wages of the workers. And as you know, since the 1970s, real wages for the bottom percent have lagged significantly. Their living real wages have not improved to a
Correct.
considerable extent. So my question to you is, might this factor have this factor contributed to lower bond yields?
Yes, yeah, I would say this is more a symptom rather than the cause itself. So obviously, if productivity levels are not materially higher year after year, and long-term trends for structural economic growth don't go up that much, it's very difficult for wages adjusted for inflation to pick up at a very sustained pace, right? So what happens is that, as you said, the median wage growth after inflation in America, so the increase in purchasing power, one might say, in America has gone up roundabout over the last 2 decades by maybe 1% a year. That's it. I mean, it goes up steadily, but not by a very large amount. And if you divide by basically cohorts of population based on income, the lower cohort of the population actually hasn't grown at all, as you say. And so that is the reflection of capital misallocation as well, where as we lever up more and more and more, and technology plays a huge part in that process as well, where we effectively move from a labor-intensive economy, an industrial intensive economy. That was the 70s, that was the 80s, where labor had a lot of importance in economic output, where labor unions had a lot of wage bargaining power, because labor was necessary without all the automation and the technology we have today to be able to produce the output which was needed in the 70s and in the 80s with an industrial economy. Today, our economy is completely different.
Yeah.
The average company needs 1/10 of the employees today in America to generate the same 1 million of sales compared to the 80s. 1/10 of the employees. So you can obviously understand that, especially for the lower, less skilled part of the labor force, it's very difficult to see their wages adjusted for inflation going up, which tends to complicate things further.
But as you also know, since the beginning of the COVID-19 pandemic, the labor force participation rate has come down dramatically. Can this improve the workers' bargaining power?
That's a great question. And the answer is partially yes, when it comes to sectors that are structurally hampered in labor supply. So labor works as any other economics law. If you basically constrain the supply of labor, then the wage bargaining power of this reduced labor force, assuming the demand is inelastic, will go up, obviously. So people will be able to demand more wages, higher wages. but that is valid only for the portions of the labor supply where the demand will be still there, right? So we're talking about a relatively skilled labor force that has maybe left the labor force because of they have reassessed their life, they have enough capital gains to retire, whatever is the reason. So for that cohort, if it is highly skilled and highly in demand, then yes, the answer is yes. On an aggregate level, because I always say do not miss the forest for the trees, a lower participation rate at an aggregate economic level actually reduces economic output, simply because there are less people contributing actively to the economy and more people that are not in the labor force anymore. And so when it comes to real GDP growth at an aggregate level for the economy, a lower participation rate is not a good thing, despite it might be a good thing for certain portion of this labor force that has more wage bargaining power.
Yeah. And I think part of the reason why the real rate of interest on long-term bonds have come down since 2020, since recently, I think that may also have something to do with the lower level of labor force participation rate, just as you just said. And so, coming back to our discussion about quantitative tightening, do you think outright sales could be an option, and how effective would that be
Yeah.
at the
So
end of the day?
yeah, quantitative tightening is a very scary thing. I wrote an entire article on the Macro Compass, which is my free newsletter, that is called QT Explained, just to make sure that people understand how that works and what is the impact. So as you can read on my t-shirt, central banks print bank reserves and not money, which mean with QE, which means that when they do QT, they don't destroy money necessarily, they destroy bank
Bank
reserves,
reserves.
which is very important, but you need to be very nuanced when assessing quantitative easing and quantitative tightening. So to explain quantitative tightening, I always start from quantitative easing, right? So let's start from what basically what needs to be destroyed. So the creation is the QE process, in which actually central banks expand their balance sheet, their liability side and their asset side at the same time. They have this power, they can do that out of thin air. And so the liability side of the central banks goes up. That's bank reserves. They're created digitally out of thin air. These bank reserves are used by the central bank to acquire bonds, mostly bonds, from the market. So they take away these bonds from the private sector. They're gone. They're now locked in the central bank balance sheet, which has increased on the liability side and on the asset side by the same size. Bank reserves on the liability side, new bonds purchased with QE on the asset side. Now, no new spendable money has been created with this process, because what happens to the private sector is that the private sector balance sheet has not gone up. The only thing that happened is that on the asset side, on the balance of the private sector balance sheet, instead of the bonds, now you find something else. The bonds have been taken away, and you find something else that are bank reserves. This happens if QE purchases bonds from a bank. If it purchases bonds from a pension fund, instead of bank reserves, they will find bank deposits. But it's always a swap. It doesn't increase, it just changes the composition. And the pension fund can't spend bank deposits on bread or anything that is in the CPI basket. They can't do that. The bank reserves are basically a tier of money that is an interbank, interfinancial system form of money. You cannot get them out. There is no way to get them out. And that is the reason why Japan has been doing QE for 25 years with no effect. And that's the reason why EU has been also doing the same. And now people then tend to say, yeah, but when QE happens, then the government can spend more. Okay, so on this part, this might be right, but it still doesn't mean QE prints money. It means it's the government and commercial banks who have the ability to increase the spendable amount of money.
Or the primary dealers.
Or the primary dealers. Yes.
Yeah.
So it's basically these guys. And so QE is the creation of bank reserves, and QT is the opposite of that, which is the destruction of bank reserves.
Yeah.
The interesting part about QT is that it has a double whammy effect. So what QT does is it reduces the central bank balance sheet. So you take these bank reserves and you erase them from the system, and you do not reinvest the treasuries that mature. That's step number one. You don't reinvest those. When you don't reinvest those, you shrink your balance sheet, but you're also telling the private sector, any newly issued bonds from the government, from a corporate, from anybody else, you, Mr. Private Sector, now need to step up marginally and absorb what we as a central bank used to absorb before, and you have less reserves than before on top because we're draining them away. So the private sector has less reserves and has more collateral to absorb, more bonds to absorb. So that's a double whammy effect, which generally speaking tends to lead to the private sector reassessing the risk taking. That's how it works. If I'm a bank and now I have less reserves and more collateral to absorb, I will still absorb the collateral. I will buy bonds. I need them for regulatory reasons. I need them to hedge my risks, whatever. But I will be less keen in buying them unless the price is right. And so this price is reflected in credit spreads, in risk premium, and it starts from bonds, and then it moves to corporate bonds, and then it moves to high yield corporate bonds, and then it moves to equities. It's all of a risk assessment that gets repriced, and the risk mentality gets repriced once you throw more collateral to the system, to the private sector, and you give them less reserves to handle this collateral.
Absolutely. I mean, I think QE is an operation whereby duration is sucked out of the private market, and QT is the exact opposite, as you just said. You issue more and more long dated bonds to the market and expect them to absorb them. And so, as you have said, I think swap spreads may widen to make holding long term treasury securities more attractive. So, I do think that during this quantitative tightening process, there'll be a lot of work to do. There'll be a lot of work for arbitrators to do when the Fed doesn't roll over those maturing securities. And speaking of longer dated bonds, how would you describe the role of the yield curve in terms of financial conditions? How does it affect the economy?
Yeah. So again, that's a topic that is of much interest for people, yield curve, flatness, steepness, inversions, and so on and so forth, that I had to write a full article on the Macro Compass about yield curve inversions. So that was back in December when I said that looking at things, at the overall macroeconomic scenario, I expected yield curves to start inverting. So to proceed to flatten further and then ultimately to invert. And so my preferred gauge for yield curve inversions is something that I called OIS swap curve. And so it sounds very difficult, but it's not. So instead of looking at treasury yield curves, I tend to look at swaps that indicate market expectations for where the Fed funds rate are going to be in the future. No other polluting elements like swap spreads, repos, regulatory requirements, none of that. Just literally the market implied expectations for where the Fed funds rate are going to be at a certain point in time. So I look at 5-year and 30-year OIS swaps. I compare, and then I put them one against each other. And the flatness or the steepness of this curve tends to predict sharp economic slowdowns pretty well. Also, 2s10s do the same, 530s do the same, but it's for me more clear, more pure to use OIS swaps rather than pollute the analysis with treasury yield curves. And I explain that in the article a bit more in details if people want to check it out. The key point is that the 530s OIS curve has already inverted. That happened on February 11th. February 14th, again, it traded at 0. And just this morning, it traded at 1 basis point. Now, if it's 0, 1 basis point, -1, or 3 basis point, the idea is the same. Basically, traders are expecting Fed funds rates over the next 5 years to go roundabout at a terminal rate of 2%, more or less, to proceed around that level. That's where, according to them, the Federal Reserve will have to stop their hiking cycle. They have reached the so-called terminal rate. Yeah. And interestingly, 30-year OIS swap rates are at roundabout the same level, which is telling you that basically traders are saying Federal Reserve can go as fast as possible for a couple of years to 2%, and then they're literally done. The private sector cannot take anything anymore in terms of hiking. So we price that between year 5 and year 30 down the road, the Federal Reserve won't be able to do much. And if this curve inverts, they're actually pricing the Federal Reserve to be forced to cut rates after year 2, 3, and 4, let's say, of hiking, because the private sector has taken too much damage from this hiking cycle.
Mhm. That's why I think the Federal Reserve will initially opt for hiking by 25 basis points. And I was listening to Jerome Powell's testimony at the Congress, and he said something in the lines of him proposing a 25 basis point hike in the first meeting, but of course in the following meetings, if the FOMC deems appropriate, they may hike by 50 basis points. But for now, there's a lot of things that are uncertain. We need to know where the growth is going. We need to know where inflation is headed. I mean, for sure, inflation will be elevated, but we just need we just need to be sure about those things. So, as you would also say, we are in a highly uncertain cycle, and in this uncertain cycle, how would you think risk assets like stocks, like corporate bonds, or treasury bonds and currencies, how do you think these asset classes will perform,
Yeah.
especially precious metals?
So the other interesting part of having managed $20 billion is that I have no problem in putting out my trades for everybody. So my portfolio allocation is available for everybody to be checked at the Macro Compass and on my Twitter account. So rather than telling you what I think the asset classes are going to do, I'm going to tell you how am I positioned. So I learned that a portfolio of somebody speaks louder than his words, let's say. And so at the moment, since the beginning of the year, with different expressions, but have been short risk assets. For risk assets, I mean corporate spreads, equities, mostly those two, and Bitcoin as well. And I've been betting on a flatter yield curve in America, which has worked, luckily for me. And there is one sector of the stock market that I think long term might actually be a good buy at this moment, which is the Chinese real estate sector. But we can cover that later. More broadly, since the beginning of the year, I've been short these risk assets or underallocated to them. It has played out. And the reason was very simple back then. The return of the stock market is actually influenced mostly by two things, which is earnings and valuations, right? So those are the two things that make up for stock market returns at the end of the year. When I assessed earnings and earnings expectations by analysts for next year, for this year, for 2022, it looked to me way too rosy compared to a scenario where the growth impulse was slowing and the Federal Reserve was tightening on top of that. And central banks around the world were tightening on top of that. And real wages were negative because inflation is rising faster than nominal wages are rising. So then I thought earnings are probably going to disappoint. And valuations, on the other hand, also, because as the Federal Reserve tighten and they embark in quantitative tightening, as we were discussing, risk premium needs to be priced a bit more robust across the board to encourage people to participate in more risk investments like equities. So neither of the two components felt to me compelled to be long risk assets. Then I took the other side, then I was short a bunch of them. So the Russell 2000 small caps in America felt to me very exposed to this environment. So I am still short these assets. Bitcoin as well, which tends to be a pretty sensitive asset, which is sensitive to risk taking. So when there is a lot of risk sentiment, a lot of risk taking ability, then Bitcoin tends to do well. When there is less of that, it tends to do less well, let's say. And high yield corporate bonds in America also were a target of my short because they're highly levered companies that need rates to be very low in order for them to be able to refinance at cheaper levels. And rates were starting to go up back then and credit spreads to widen. Then the yield curve flattener bet in America, so between 2-year and 10-year using futures, that also worked. And the Chinese real estate, which I'm long, and it's not trading very well. And that's because China has actually taken the other stance, Gaia. Since the beginning of the year, they started to ease monetary policy with the PBOC, but most importantly, Xi Jinping has been very clear that he wants the bleeding to stop in certain sectors by allowing credit to be again extended to these real estate developers, which have been under massive trouble in 2021. And so obviously this will take a little bit of time to play out. If you try to make credit go through the sector, it will take some time before it turns into earnings and turns into a more rosy economic scenario for this sector. But I anticipate the move, and I already position long for the Chinese real estate sector. When it comes to gold and other precious metals, now obviously we started the year on the wrong foot for valid reasons. if you expect so these commodities are priced in dollars, right? So people always forget that there is a real asset and there is a denominator for this real asset to be priced. And these real assets, let's say gold, is priced in dollars. If you make the cost of owning dollars marginally less punitive than a year ago, which means in inflation-adjusted terms, owning dollars on a bank deposits becomes less punitive, real rates are going up, in other words, it becomes pretty, and you combine that with a tighter monetary policy stance, you combine that with slowing growth, it becomes palatable for people to want to hoard more dollars and marginally less other assets, gold included, other assets that are priced in dollars, gold included. Now, we started the year with gold selling off a bit. I was pretty impressed by his, let's say, by gold stability, despite this macro backdrop. So it sold off a bit, but not much. Now the situation has reversed because inflation expectations have started to move up pretty aggressively. In America, 5-year forward, 5-year inflation expectation, looking on my terminal, they are at 2.75% today. So we have broken up of a range, let's say, that has held for a while. And nominal interest rates are rising, but not that much. So then again, the marginal cost of owning dollars is becoming more punitive again, which is giving a boost to gold together with the geopolitical tensions. I honestly don't have a very strong position, which is expressed in my portfolio. If I don't have a position, it means I don't have a huge opinion of where it's going to go. But that one observation, gold has behaved extremely well at the beginning of the year, despite the macroeconomic environment, which wasn't supportive, which probably tends to say that a lot of people were short gold, and now they're covering and they're flocking to it because of geopolitical tensions. Last thing to say is that the Russian situation is very interesting for gold here, because Russia is basically find themselves frozen on the access on FX reserves in euro and dollars, effectively frozen, which leaves them with access to Chinese renminbi and gold mostly as their alternatives. They own a lot of that. So short term, it's interesting to see if Russia will be somehow forced to liquidate some of their positions to raise the money they need for their economy not to collapse, in other words, and try to defend the ruble somehow. On the long term, sanctions on FX reserve on a very large central bank like Russia can be a deterrent for other jurisdictions to own much of these FX reserves in dollars and in euros, because they might be afraid they could be subject to a similar treatment, which makes hard physical assets and valuable assets like gold a potential outlet for a reallocation of FX reserves from certain jurisdictions.
Yeah. And what I observed about gold is that, well, we saw a very strong correlation between negative real rates and the price of gold, especially over the course of 2020. What I also observed is that despite the fact that in normal times, people allocate a relatively small percentage of their capital for gold, but when they expect negative events to occur for risk assets, they tend to allocate more of their capital for gold as insurance. So that's one interesting aspect. And in terms of, let's say, the euro dollar parity, I mean, that gained a lot of attraction in the recent days. And what do you think? Where's it headed? What do you think about that?
Well, so the euro dollar drop is understandable from a macro perspective for a couple of reasons. The first is energy driven. So Europe's energy policy is not very well planned, let's say, because the production of energy out of Europe is very small compared to the required consumption of energy in Europe, which makes us, I'm European as well, very reliant on external sources. And in this case, let's say Russia was supplying Europe with a lot of energy. Now, obviously, if there is basically an embargo on Russian commodities, it makes the situation very complicated for the Eurozone in terms of energy importing, which naturally weakens the growth outlook and weakens the euro as well. Now, against the dollar, as this is a relative question, so euro against the dollar, the US is much less subject to this. They have in-house production and they're not fully dependent on Russia or highly dependent on Russia, let's say in terms of energy imports. But also the Federal Reserve might be, let's say more keen in tightening monetary policy on a relative basis than ECB is. So the combination of the two and the fact that the dollar, when there is some deleveraging, some risk off, tend to attract natural flows from people that have to effectively reduce their risk exposure and go back to a safe haven asset. Well, it all makes sense, right? That euro dollar goes down. Now, going forward, there is one part of the picture that many people are not considering at the moment, which is that the fiscal impulse in America is completely exhausted. So the last, checks that were sent to Americans and the last proper fiscal impulse was done in March 2021, which means that, growth is slowing down to trend quickly. In Europe, the situation is a bit different because a lot of the fiscal impulse has been announced during 2020 and 2021. But by the nature of the European Recovery Fund, most of these funds will be disbursed this year and next year, which means the fiscal impulse is delayed in time, which means the impulse to growth and the return back to trend is also delayed in time. So in other words, I expect the European economy to do relatively well, barring, of course, further escalations and energy constraints here and there. But simply from a fiscal impulse perspective, Europe is positioned a bit better. So perhaps if we see a de-escalation in these Russia-Ukraine tensions and a slowdown in commodity prices, then because of this delayed fiscal impulse, Europe can perform relatively well in the second half of the year.
All right. And my final question to you is, and after this question, I'm going to move on to the questions on the comments section. When and how do you think the global inflationary bias will fade eventually and hopefully?
It's a tough question. So my base case is that, that inflationary pressures would dwindle away in the second half of the year relatively aggressively. The Federal Reserve has a forecast for core inflation at 2.7% by the end of the year on year. And that was already a relatively aggressive forecast. I tend to agree with that. Obviously, the commodity price surge has completely changed the equation here, and nobody could predict a war, whatever they say. So you tend to reassess your environment here, and obviously having a sub 2.5% inflation by the end of the year becomes almost unachievable at this stage because of the inflationary pressures we will be seeing in CPI over the next few months because of the commodity surge. Now, even if you consider that, it's very difficult for inflationary pressures to be sustained, and you guys in Turkey know that, if there is no credit creation, if the aggregate demand basically doesn't pick up, and if it doesn't become rooted in people's mind that accessing this credit is a way to basically reducing your exposure to a reduction of purchasing power. So if you get this mentality and you borrow more and more in this currency because you know it's going to lose power, and you tend to reallocate your assets into hard assets that are not going to lose their purchasing power over time, if you don't go into this dynamic of continuous credit creation, it's very difficult for inflationary pressures to remain anchored on the upside. So this credit creation is slowing down. It has already slowed down. The inflation upside we see now is basically solely due to surging commodity prices. So the base case has to be a slowdown at some point, probably delayed, of course, because of the war. But I would expect with a de-escalation sooner or later, we should see the peak finally in inflationary pressures. It should be about time because they're hurting the purchasing power of people. As I said before, real wages are negative. So wages are going up, but inflation is going up faster, which is not good for the private sector.
Yeah. Okay, so we still have some time, so I would like to move on to the questions on the comments section.
Sure.
I'm opening them. All right. So this person asks, what do you think about the prices of the real estates in the world?
Again, an article on the Macro Compass on real estate has been released recently. So if you want the full opinion, you can go and check it out there. In short, I expect the real estate market to slow down a bit this year, but over the long term, because of the design of this game, of this monetary system that we have, it's very difficult for real estate to slow down. And why is that the case? Real estate prices can basically be considered as bond prices. And the reason why I say that is that most of house purchases in the world are financed with a mortgage, with a long mortgage, generally above 10 years, most likely 30-year mortgage in terms of duration. And this mortgage is nothing else than a long duration bond whose coupons need to be serviced according to interest rate with wages, right? So you have a wage that you earn, you have a mortgage, and you have to pay each year a certain installment of this mortgage. And the more you can afford to pay, the higher the mortgage you can get, the higher the house prices are going to be. Now, the trick has been over the last 20 to 30 years to make sure that mortgage rates are lower and lower and lower and lower. So even with the same wage adjusted for inflation, as Kaya said before, real wages haven't gone up massively. But assume the same real wage that you had 20 years ago, adjusted for inflation. If you could borrow with that wage 250,000 euro, for example, 20 years ago, at a 5 or 6% real borrowing cost for you, if the real mortgage cost is now 2%, you can borrow 300 or 400 euro with exactly the same wage, because the cost, the mortgage installment, has not gone up, has remained the same despite the mortgage being larger because of interest rates having gone down. So this wealth illusion effect, where you feel like that you can afford a much more expensive house, leads actually to house prices becoming more expensive because the marginal buyer, through a cheaper mortgage, can afford a more expensive house. And the guy who sold the house or is about to sell the house feels richer and richer. It's a wealth illusion effect, basically almost fully driven by lower real mortgage rates. And this wealth illusion effect is paramount important for consumer spending. If you feel your balance sheet is wealthy because your house prices are going up and your mortgage cost is basically fixed, the mark to market of your balance sheet is larger. And as it's become larger, then your spending ability and your purchasing power and your approach, let's say, to consuming becomes more aggressive, which boosts GDP growth and consumer confidence, etc., which is what policymakers want to see. So this is a trend that I can't imagine being explicitly withdrawn from regulators. It can get slightly dampened down, but the trend will remain possibly for real estate prices to continue to increase as long as mortgage rates continue to drop.
There's also one question that I missed, which is right at the top of the comment section. This person asks, "Hi Alf, do long bonds respond to just monetary inflation or also supply shock inflation? If both, why can't the Fed control both types of inflation?"
So let's say long bonds, as explained before, structurally speaking, they respond to long-term economic forces and inflationary forces. And those are driven by technological advances, the level of debt in the economy, labor supply growth, and the productivity in the world. Those are basically the four major forces. There are others, but those are the four major forces. This is long-term. I'm talking about a long-term trend of long end bonds. In the short term, yeah, of course, long bonds respond as well to monetary policy. We talked before about being behind the curve, and that historically would lead to 30-year bond yields going up, because if the central bank is accommodating way too much compared to what the economy would need today, it's basically letting the economy overheat, which will let trader temporarily to price a higher risk premium for inflation and growth, and therefore to demand higher yields in order for them to buy long end bonds. This is again only a temporary thing because central banks work in cycles. So if they let the economy overheat too much, effectively like it happened in 2021, what they're going to do is what they are planning to do in 2022, which is to slow down this overheating and to revert back to trend. So you move back again to this long-term trend in long bond yields, and the structural drivers are not the monetary policy shocks in this case.
Right. And this question is related to your portfolio, I guess. And this person asks, "Are you bullish on small tech companies on NASDAQ?"
No, that's definitely a no. So small tech companies on NASDAQ effectively are strong growth or projected cash flow growth companies whose cash flows, though, are only available very much down the future. So you'll have to wait 10 years for these companies to become profitable. effectively. So you're buying very long-term, potentially highly growing cash flows, but down the road, which means that as you have to discount these cash flows to today using real interest rates, if real interest rates are moving higher, let's say, or you expect this to be the direction temporarily speaking, because monetary policy is becoming less accommodative, and if you expect risk premium to be repriced, this is definitely not the sector you want to be in, because you care about cash flows today. In an environment where you have less risk-taking ability, you reprice risk premium, real interest rates, so discounting factors go up. If you have cash flows, yes, potentially highly growing, but much, much down in the future, yeah, those don't work well in this environment.
Okay. And also, right at the top of the comments section, there's this person whose comment I missed. So he asks, how can I protect myself against inflation?
Good question. So the long-term answer to this question remains equities, in my opinion, which is a very unusual answer. But let me try to help you out. So many people would refer to hard assets as an outright protection for inflation. And that is true, but equities are effectively a hard asset because you're buying cash flows of companies over the very long term. As long as you buy them at a reasonable price, these cash flows, and you buy cash flows from companies that have a power to reflect and to transfer inflationary pressures back to consumers. So basically, they can keep their margins relatively intact during inflationary periods. These cash flows are inflation protected. So you are not only buying, let's say, a hard claim on cash flows, but potentially on inflation adjusted cash flows. And that makes equities a potentially superior inflation hedge. In general, any asset that is able to, track and generate hard cash flows. So for instance, residential real estate is one of those as well, because the land, you cannot deflate that away, or the rent you receive can be adjusted for inflation as long as wages are not dropping. These sort of assets that generate cash flows that are hard and inflation adjusted cash flows are by far the best way. And then the other way to do that, obviously, is with hard assets that do not produce cash flows. And those are commodities, generally speaking, because you simply can't produce more of that despite basically the spendable amount of money in the world going up and causing inflation. You can't print gold, you can't print oil, you can't print copper. So obviously commodities, but in my opinion, hard inflation adjusted cash flow generating business, those are the best ways to hedge.
And now let's take the last question, which is Bitcoin the best to hedge against inflation running faster than wage increases?
Well, no is the answer. Unless, like I do, I own 2% of my wealth in Bitcoin. It's not 20, not 100, it's 2%. And the reason why I own 2% in Bitcoin is because if you really think decades down the road, with a combination of technology advancements, but also with a combination of this monetary system being really pushed on a string, with real interest rates moving down, down, and down, there are limits to the point you can kick the can down the road effectively in this system. And so if you have to really be creative and think of reset is a big word, of think of a new monetary policy system, new monetary system, where we can think about credit and money in a different way, then digital assets might play a role. So it's a lot of ifs, as you can see, and that's why the allocation is 2% and not 100%, because digital assets might play a role in this new system where we reassess how we think money and credit. But there is a big difference between having a probabilistic assessment of what might happen and therefore a small allocation to digital assets in your portfolio and saying that Bitcoin is the ultimate inflation hedge. I think that's a bit too much, probably.
All right. So thank you so much to everyone for being with us today in this live discussion. And thank you, Mr. Peccatiello. It was a great privilege to have you here. Mr. Peccatiello and I discussed the global macro picture. I hope everyone enjoyed. I definitely learned a lot of things during this discussion. So I wish everyone a great day.
Thank you,
Bye.
Kaya, for it's been a pleasure to be here. Ciao, everybody.
My pleasure.